UBS, Mary Second Lynch, and Credit Agricole in their London and Paris offices. Mr. Joseph holds a PhD in management apart from a master's degree in economics and philosophy. Welcome again, sir, and thank you so much for sparing your time coming here and talking to our students. Over to you, sir. Sir, you are on mute. Yes.
Thanks, Dr. Parul, for the words of welcome, and also Vinita for organizing this session at the Institute. Thank you very much, and dear friends, welcome to all of you to this brief presentation on some of the portfolio selection theories. These are 2 or 3 theories that we would be dealing with. One is the efficient markets hypothesis, and then we'll look at a couple of other theories. But one of the things that we need to understand always is that portfolio management in practice, what you actually practice and what you do at the desk where you are employed or in the department where you are working is quite different from all these theories that we study. Probably you take small parts of each theory and put them along, and then that would determine how you are going to manage the portfolio. So portfolio management in practice and portfolio management in theory are 2 different things. But at the same time, it's very important that we should have fairly good grounding in portfolio management concepts to understand what portfolio management is and how do we actually manage a portfolio. I hope I am audible to all of you.
Yes, sir. You're perfectly
Yeah. Thank you very much. And I'll now start the presentation. The presentation is split into broadly 2 parts. In the first part, I would like to discuss some basic concepts which are relevant to investments and portfolio management. And in the second part, we look at the 3 theories or hypotheses that we need to look at as part of this session. The concepts which we are discussing in the first part, actually, I have put it together only just because it is essential that you have some grounding in those concepts before you move on to the theory. Even if you do not understand the theory that well, if you understand some of the basic concepts which go into those theories or which form the basis of these theories, if you understand that, then that will be a very good achievement, which could take you far as we move further ahead in life, in your career and all that. Now I'll start the presentation and are you able to see the presentation now?
So we can see the screen, but the presentation is, I think it's still not visible, but we can see your screen, sir.
So if you can download the presentation on your desktop and then you can share.
So now it's visible.
So it's visible now?
Yes, sir. Yes,
Yeah.
sir.
Thank you very much and welcome to this presentation. As I told you, on some of the basic concepts that we should be looking at, and those concepts are put in there deliberately as a preparatory background for further discussion as we move ahead, and also for better understanding of the three hypotheses that we would like to discuss. When we, as I told you, some of these concepts will be useful for you as you go further ahead, when you take up a career with banks, financial institutions, mutual funds, etc. And if you are in portfolio management functions, or even if you are in functions where you interpret portfolios and evaluate portfolios while recommending investment products to investors on a regular basis. But what is more important and what's relevant to us is that we should, the actual experience that you get at a portfolio management desk is what helps you understand the things in a better perspective. What is a portfolio? A portfolio is not just a collection of securities.
Excuse me, sir. Just would like to inform you. Here, the students are from Jaipuria School of Business, and you have mentioned in your first slide Jaipuria Institute of Management. So, just wanted to inform you. So, here students are from Jaipuria School of Business. These are the PGDM students.
Okay. Thank you very much. I'm sorry about that incorrect first slide. I'm sorry about that. Thank you for pointing that out to me. It's a collection of securities or instruments, but it's not a collection of securities or instruments which are just picked up at random or anything like that. It is deliberately and purposely picked up and put together with a specific objective. So when you, so a portfolio is a collection of securities or instruments, but it is specifically picked up deliberately and put together with a specific objective. Also, in a portfolio, you may have different types of instruments like shares, Government of India securities, corporate bonds, fixed deposits with banks. These are all instruments which become part of the portfolio. These are all specifically picked up and with an objective, because there are certain risk return expectations associated with these instruments. And it is chosen by deliberate design. And what is the design? That design is actually the risk return expectations. In a portfolio, there are a few things while setting up a portfolio or while looking at a portfolio. There are a few things that we need to understand. One is that all the portfolios that you may be looking at of an individual investor, institutional investors, etc., they serve certain objectives or goals of the investor. Some investors would be looking at return maximization. Some would be looking at some goals in life, like buying a second home, having a foreign trip, or retirement planning, children's education, etc. So portfolios have specific objectives. And second thing is that portfolios are not created at just one point in time. Generally, portfolios are constructed over a period of time. It's not that it's constructed at one particular point of time. It takes time and it's created over a time horizon. So whoever is investing, whether it's an institutional investor or whether it's an individual investor, they invest over a time period. Another feature of the portfolio is that generally the portfolios which people set up have a feature of permanence. It's not a temporary thing that they have put up for 1 month, 2 months, or 3 months. Generally, portfolios run for any time period from 5 to 10 years. That's the time horizon for which it usually runs. While also setting up portfolios over a time period, generally investors and also portfolio managers follow the principle of core portfolio and satellite portfolio. Core portfolio is the major component of the portfolio, probably about 70-80% of the portfolio, which are held for the purpose of, which are held for a longer time or for a longer time period. The balance amount of 20 or 10 or 20% is something that is used for tactical allocations. In strategic allocations, you take specific views and you stay invested in instruments and portfolios, and you stay invested for a very long time. That's called the core portfolio. As far as satellite portfolios go, the investment will be in certain ideas or in certain tactical positions. Tactical positions are positions that you take in the markets or investments that you make with a relatively short-term view, maybe 6 months or 1 year view, and you stay invested only for that long a time period because that is what a tactical position is, and there could be certain opportunities which come up in the markets on a regular basis for which that component of the portfolio, which is the satellite portfolio, would be the part of the portfolio which will be used to ensure allocation to such objectives. So portfolios have a core and a satellite component. Core is strategic allocation and the satellite is tactical allocation. In the portfolio types, generally we have, because in India we are acquainted with mainly rupee portfolios because that's the basic currency in which portfolios are set up in India. And sitting in India, you can set up portfolios in foreign currency also because government of India has already, and the Reserve Bank has permitted 250,000 US dollars to be invested abroad in foreign currency denominated assets as well. So you can even buy direct equities abroad, and also you can invest into international mutual funds. You could acquire some real estate also abroad. Whatever is possible within 250,000 US dollars, you can invest abroad. These are foreign currency portfolios. Then we have multi-currency, multi-asset class portfolios. Usually the asset classes in which portfolios are set up are the traditional asset classes. These traditional asset classes are equity and debt, or fixed income and debt. Fixed income or debt and equity are the two basic asset classes in which investments are usually made. And these are the basic asset classes. So in multi-asset class portfolios, you see equity, there is an equity component, there is a debt component, and also you see a component of maybe, gold, international funds, etc., etc. Some real estate also through real estate investment trusts. So you have multi-asset class portfolios also. When you look at a portfolio, when you take a look at a portfolio the first time, you should see what is the asset composition of that portfolio. Is it a pure debt or fixed income portfolio, whether it's a equity portfolio, whether is it a rupee portfolio entirely or is it a multi-currency portfolio. Multi-currency portfolios means you take exposure in the portfolio to the US market as well as the Japanese market or even to the European markets. So you may have investments or instruments denominated in US dollars, means US market shares or US dollar fixed income instruments, or US dollar denominated mutual fund schemes in the portfolio. You may have euro denominated as well as Japanese yen denominated, say the Japanese government bonds, etc. So you have multi-portfolios where you have fixed income, debt, gold, real estate, etc. In multi-currency portfolios, you have portfolios in multiple currencies. Because over a period of time, because we have not been seeing these things in India, the multi-asset class as also multi-currency portfolios have not been that popular because in India we were restricted mainly to equity and debt. But we have seen a culture of people investing into foreign equity funds and also foreign direct equities abroad, etc., especially during this pandemic and the lockdown. A lot of people invested abroad in the US markets. We are not used to multi-currency portfolios also, but we are gradually going to see a lot of multi-currency portfolios when it comes to evaluating those portfolios or when it comes to managing such portfolios. We also have thematic portfolios. Thematic portfolios are portfolios which are built around a particular theme or particular idea. And this theme is actually, say for example, in India it could be say infrastructure is a theme on which you can set up a portfolio. Then it could be specific sectoral portfolios like a portfolio of banking shares or BFSI shares, including insurance and NBFCs. So these are called thematic portfolios. These portfolios are set up, consumption is a theme on which funds are set up and portfolios are set up. So these are thematic portfolios. There are people who look at, constantly look at opportunities for investing into these thematic portfolios and also new themes that we keep on getting from time to time. These are the different portfolio types. So actually, when you look at portfolios and portfolio management, you come across different types of portfolios. When you when you look at the portfolios very closely from the portfolio selection point of view, because you will be selecting an instrument for the portfolio. And this instrument could be a fixed income instrument. It could be a Government of India security. It would be a Government of India security issued by the central government, issued by the Reserve Bank of India on behalf of the government. The portfolio could contain corporate bonds issued by various corporates in India, rated by CRISIL, ICRA, etc. Portfolios would also contain, as I told you, some fixed deposits and instruments like that. It could also contain treasury bills. Then there are shares and shares which become preference shares, normal listed shares on the stock exchange. All these instruments form part of the portfolio. And when you set up a portfolio, there are certain basic considerations that you have when you set up the portfolio. Some of the considerations are very fundamental while setting up a portfolio, because only if the instruments meet those basic fundamental criteria, you move on to the advanced criteria. Say, for example, when you there are certain hygiene factors. Say, for example, when you are picking up an instrument or a corporate bond, you have to follow certain hygiene factors. Or if you are investing in a mutual fund scheme into debt or equity, you have to look at certain hygiene factors. And what are these hygiene factors? Hygiene factors are basic minimum conditions which should be satisfied by the instruments which form part of the portfolio. Now, what are those hygiene factors? Say, for example, when it is a mutual fund, we look at the size of the mutual fund. The mutual fund size should be at least 10,000 crores. The product should have at least 5,000 crores of size. The product should have a minimum track record of at least 2 years or 3 years. So the size of the institution, the size of the issue, the outstanding issue in that particular instrument or product, and also the track record of the product. The product should have a minimum track record. When it comes to a Government of India security, we need not have to look at these factors because it is sovereign risk. Sovereign risk means it's higher than even a normal AAA. It's guaranteed by the Government of India. So hygiene factors apply when you look at mutual fund schemes, when you look at corporate bonds, and you look at products which are issued mainly by private issuers. Also, if there are instruments which are guaranteed by Government of India and all that, we need not have to be too much concerned about it from that perspective. The second thing that we always look at when in an investment activity, Dr. Parul, I am on track. Is it okay?
Yes, sir. Yes, sir. Perfectly okay, sir.
Yeah, because I want to prepare the ground and then go on to the 3 hypotheses and be done with it.
Sure, sure, sir.
Yeah. One of the things that we look at is liquidity. Wherever you make investments in your portfolio, suppose you are setting up a portfolio, you're a portfolio manager at a bank or at a mutual fund or with an NBFC, and you're setting up a portfolio. The most important thing, especially nowadays, you need to look at is liquidity. You have to be very careful about that liquidity, because it's possible that you buy something today and tomorrow that company could default and it will have no market, and it's a credit risk also. That also you need to look at. Second is that when you pick up an instrument, you should be sure of it that maybe after 10 days or 15 days or after 3 months, if you want to liquidate that instrument, you should be able to sell it to someone. Someone would happily take it and give you cash at the ongoing price. That's the liquidity aspect of the investments in the portfolio. I have touched upon hygiene factors as the minimum essential factors. Then comes the liquidity, which means that you should be able to sell the instrument of whatever quantum it is and then realize the cash if you need cash in your company for your portfolio, or if you want to exit that particular instrument, you should be able to do that. Second is the security aspect, which I just mentioned, that the credit risk aspect. Credit risk aspect is also very important now, mainly because we know that the banking system has been saddled with huge NPS. Close to 15 lakh crores has been the NPS of India's banking system, mainly with the public sector banks. Now those NPS are gradually being recognized, written off, realized, provision being made, so that we are coming out of that. But as you know, we have been going through this pandemic, and there was a moratorium on repayments of loans and all that, which the government of India extended, and which the banks extended to their customers. So it is felt that the credit risk on account of these conditions of, because the GDP growth was minus 23%, which means the economy hasn't been growing. A lot of people have been thrown out of employment. Businesses have not been able to generate sufficient output, sales and revenues. Therefore, the repayment capacity of these entities would also be in jeopardy, in danger. Therefore, when we pick up instruments from the markets, we need to be very careful. Or when you are buying a new instrument and wanting to put it in the portfolio, we need to be careful, because it has to be secure. It should conform to certain minimum credit rating standards. It should be a good AAA rated paper, or it should be a good AA rated paper. And you should also need to look at who is the issuer and who is the entity who has borrowed money. Those things need to be looked at. That is hygiene factors, liquidity, security, mainly credit risk, because at this point of time we face a very high level of credit risk. Mainly because if you look at the latest report of CRISIL, ICRA and all, they have indicated something very important. They have said that the number of rating downgrades has been higher than the number of rating upgrades, because ratings may be upgraded from AA to AAA, and ratings may be downgraded from AAA to AA. This is what the rating agencies do on a continuous basis. Now, if there are too many rating downgrades from AAA, many have been downgraded to AA, and there are too many, and there are fewer rating upgrades, that's AA's being made AAA. In that case, the situation is not good from the credit risk point of view. There have been more downgrades and a lesser number of upgrades. So the situation needs to be monitored very carefully and cautiously. And when you pick up securities, you need to look at the credit risk, which is reflected in the security aspect, which is indicated there. Another thing is profitability, because whenever you make investments, what you do is that you always try to see whether what you are investing into is a profitable thing. Am I going to get the coupon on a regular basis? Am I investing at a yield, or a yield which from where the yields could move down rather than go up? Because if yields start moving up, then we tend to make losses, capital losses, and if yields move down from the yield at which we picked up the security, we make profits. I hope you have studied all these things in the security analysis and portfolio management course in the earlier chapters and papers. So what happens is that when you pick up an instrument, say for example, another thing is from the context of the stock market. Are you able to see the presentation?
Yes, sir. So we are on this page, some basic consideration, hygiene factors, liquidity, security, profitability.
Yeah, I've got it. Because I have come in I come into the office only 2 days in a week. And once I come in and connect my laptop and all that, because we have a very rigorous risk management system out here. So it keeps on showing something or the other, so that it had clouded my view. So profitability is the final thing. Now there are other considerations apart from the hygiene factors I told you, the liquidity, security and profitability factors. One of the, there are two important things, because as portfolio managers, you may be dealing with corporate treasuries, or you may be advising corporate treasuries, and corporate treasuries may be seeking your advice on various things, as also individuals would be taking your help as far as a constitution of their portfolio is concerned. Now, as per SEBI guidelines and SEBI instructions in relation to advisory services extended by entities in the markets, there are one or two things which are very relevant at this point of time. I thought that I should not miss out on that. Those two things are, one is risk profiling and the other is the board guidelines. Whenever you are meeting an individual investor, or you are advising on a portfolio or setting up a portfolio for an individual investor, you need to do some what is called risk profiling. I don't know whether you have done risk profiling yourself with some of the banks or with some wealth management or advisory firms. If not, you could get a form for risk profiling from one of the standard institutions like an HSBC or a State Bank of India, SBI Wealth, and you can take a look at it. It's called a risk profiler. So the risk profiler is usually a set of 10 questions. You answer those questions, which means that you may not be answering, but if you're advising a client or an investor before setting up his portfolio, you need to complete this risk profiling. You understand what is the risk profile of that investor. Now, when you understand the risk profile of that investor, investor, then it becomes easy for you to suggest a portfolio because that portfolio will be acceptable to the investor and will be pleasing for you also to offer, and it is legally binding on you to do the risk profiling and then only advise on a portfolio or set up a portfolio for an individual. So the document is called a risk profiler, and using the risk profiler, we will be able to understand what is that person as an investor, what kind of a portfolio can be given to him, what is his capacity to invest, what is his awareness of financial markets and instruments, and what is his temperament as an investor. Some people may not even like to take 1% loss on the portfolio. Some people may be okay even if the loss is 30% of the portfolio. If there is depreciation, they have a higher risk profile. Accordingly, you set up the portfolios. I thought that I'll tell you about risk profiling because it has become very important after the latest instructions from SEBI on the importance of risk profiling, and that it is mandatory before you set up a portfolio for an individual. Risk profiler and risk profiling. Based on risk profiling, we set up model portfolios. We set up maybe generally wealth management firms, advisories and all that. We set up 5 to 6 model portfolios. And of the model portfolios, 4 or 5 of them, we offer one of the portfolios to the individual investor or to the institutional investor. The second thing, so you have understood the individual and thereafter you are offering him a portfolio or setting up a portfolio for him. That is the purpose of risk profiling. Understanding the profile of the investor, then setting up a portfolio for him, and therefore his risk profile and the portfolio that you set up, the risk return profile will be in congruence with each other. The second thing is that when you may be dealing with, once you're out of your management school once you are out of the management school, you may be talking to a lot of corporates also and wanting to advise them on what they need to do. There, what you need to do is that you need to ask the corporate treasury or the institution to give you the board guidelines and the internal control guidelines which are there in relation to the particular activity, that is investments. Generally, the boards or a committee of the board would put in place a proper guideline covering various aspects, quantum, quality, credit rating, time horizon. It covers all these, and also it will also specify the hygiene factors that you should not get into this type of instruments. You should not invest for longer than 5 years. You should not get into an instrument which is more than 10 years of maturity. All these things are put in the board guidelines or the internal control guidelines. Sorry. And that's the basic document as far as a corporate entity is concerned. So risk profiling for the individual and board guidelines or internal control guidelines for corporates are the two tools with which you understand those entities and advise them on their investments. As far as portfolios go, it is not enough that you set up a portfolio with the help of the risk profile in the case of the individual, and also as far as the corporate is concerned based on their board guidelines. When you manage portfolios, you have to evaluate your performance. While evaluating your performance, one of the things that you need to look at is how to evaluate the performance, because the portfolio will be generating one number, that is the return. And that return has to be compared with another return. And where do we get that return? That return you get from the benchmark. So whenever you are managing portfolios, whenever you are setting up a portfolio, picking up instruments for the portfolio, according to risk profile or board guidelines, you will either set up a benchmark for that portfolio, because the benchmark is that measurement or that tool which will help you to measure your performance or the performance of your portfolio against an independent outside benchmark, which is independent of your portfolio. Say, for example, I set up a portfolio of equity shares which are listed on the stock exchange, and I invest into equities mainly in the large cap space. Large cap space means all the companies listed on the stock exchange and whose ranking or rank in terms of market capitalization is from 1 to 100. They are called large cap companies as per SEBI. So companies which have market capitalization rank from 1 to 100, they are called large cap companies. So suppose I set up a portfolio for an individual or a corporate treasury, which is a large cap portfolio from 1 to 100. Then what do I keep as a benchmark? Because I am not going to invest into all the 50 shares of Nifty 50 or the Nifty 100 shares. I'll not be investing into all those shares. I'll be investing into only 15 or 20 shares or scripts, or I may invest into 25 or 30 of them. I'll not be investing into all the 100 which are large cap. So I will apply my criteria and standards, quality norms and all that, and select 15 or 20 or 30 shares, and I set up a portfolio. Now, when I have set up a portfolio, what do I benchmark, or how do I measure the performance of my portfolio, that which I have set up for an individual or a corporate, with 25 shares listed on the Bombay Stock Exchange from the large cap space? I will pick and choose an appropriate benchmark. And what is that benchmark for me most appropriate? I can take Nifty. It's the 50 stock index, or I can take Nifty 100. I should take one of these indexes as a benchmark, because these indexes will have a performance for the next 1 year. Today to next 1 year, the index would have moved up and down, and I can get a performance number for this index. Say, for example, if that is 5%, and the portfolio of large caps which I set up of 15, 20 stocks, if it has given me say like 7%, so the difference between the performance of the portfolio that I set up and the returns on the benchmark, that difference is the outperformance. That is the importance of setting up a benchmark. So wherever you deal with portfolios, in your capacity as an investor, in a portfolio, in your capacity as an advisor to a portfolio, or whether you are managing portfolios, everywhere and always you will encounter a benchmark. Generally, when we speak about a benchmark has to be a tool or an index which is known to all the people, the performance of which is very transparent and not influenced exceedingly by any single factor, and it should be visible, measurable, and it should be very liquid. These are all some of the features of a benchmark. So whenever we set up a portfolio, there is a benchmark. And in other calculations also that you would make for the portfolio, some of the measurements, because when you measure performance and all that, there are both return-based factors and risk-based factors. And a lot of the risk-based factors, you need to measure your performance against a risk-free rate or against the benchmark. And I think I have discussed sufficient on this benchmarking and the importance of that, what a benchmark is, and why do we set up a benchmark that is specifically to measure the performance. If I have done exceedingly well in managing 20 or 25 stocks and giving a good return to investors, and investors could have even otherwise could have invested into the 100 stocks on Nifty 100. But me, by suggesting a portfolio of only 20 stocks, has helped them realize a return which is higher than that of the a passive index return. That is benchmarking. This is a table which I thought that would be of. This is a table which we usually prepare. This covers some of the large cap funds. Say, for example, the Axis Blue Chip Fund, BNP Paribas Large Cap Fund, Can Rebecca Fund, ICICI Pro Blue Chip, and all that. And let's look at the 1-year returns on these funds. Axis Blue Chip 1 year is 5.09. Can Rebecca Blue Chip Equity 13.29. Then you have BNP Paribas 5.13. ICICI Pro Blue Chip Fund 2.61. Now these are the returns given by these schemes, mutual fund portfolios, large cap portfolios in the last 1 year. And Mirai Asset is at 5.48. Now let's look at what Nifty 100 has given, because these funds invest into Nifty 100. The returns given by Nifty 100 is 5.83. So 5.83 is the return given by the benchmark. Sorry, 6.36. I'm sorry, it is 6.36 is the return given for the 1 year by the Nifty 100 benchmark index. And I think there is quite a substantial outperformance when it comes to Can Rebecca Blue Chip Equity. And if you look at Axis and BNB, the performance is, there is some minor underperformance, but there is nothing substantial. So these two are okay. There is an outperformance here in Can Rebecca, and there is an outperformance here in Mirai also, and an underperformance in the ICICI Pro Blue Chip. This I thought that I'll show it to you to show you how we compare the performance that we get from various schemes, instruments, and products. Sorry, and how it is benchmarked to an index. Now coming to, so we leave those basic concepts, but again we stay with some other concepts which are relevant. I felt that it is very important that I touch upon these concepts, because it will be very useful for you even in reading some of the literature available on various theories and hypotheses and all that. You will be able to understand it much better. There is plenty of material available in libraries in terms of published textbooks, articles, and also on the net. Now, as far as when we look at efficient market hypothesis or even random walk theory and arbitrage pricing theory, everywhere there are discussions about the relevance of fundamentals and technicals. In an efficient market hypothesis too, there is discussion of that. Then we have the other theories also, like a random walk theory, whether fundamentals and technicals are relevant or not. Because we have been using fundamentals and technicals all the time in our studies, in our analytics. But there is quite a bit of frustration with fundamentals and technicals in some of the quarters. For example, in random walk theory, they say that all these analysis and all that is not relevant at all, because you can't predict anything because market moves in a random fashion. It's unpredictable. So these things are not relevant. So let's see, we'll understand fundamentals and technicals. I do not know whether you had, sorry, you had any full-fledged lectures on what are fundamentals and how do they influence markets, prices and portfolios, what are technicals, because fundamentals and technicals by themselves are very elaborate topics which are dealt with and studied over maybe 8 to 10 hours of lectures in a very comprehensive way. And these are very, very important areas when it comes to setting up portfolios, managing portfolios, and also by understanding some of the portfolio nuances. Now, we'll go to the definition of fundamentals, technicals, and we'll also look at some charts and graphs as to how they work before we move into the more core discussions on one or two theories that we need to look at. As far as fundamentals go, when we look at an economy, the fundamentals are the rate of GDP growth, the rate of inflation, the index of industrial production, the purchasing managers index, the rural inflation versus the urban inflation, the credit growth, the fiscal deficit of the government of India. There's so many things like this which are very fundamental to the macro economy. That is at the macro level, at the top of everything. These factors are called fundamental factors because markets, economy, markets, all these things, all these entities move in line with the fundamentals, because fundamentals are created by them or fundamentals help them move in particular directions. We can also have industry analysis at an industry level, wherein we look at specific industries like iron and steel industry, IT industry. We look at the fundamentals of those sectors or industries. And then finally, we move on to the more micro level, the company analysis. We look at specific companies. So your analytics can be at the macro level. When it comes to fundamentals, it can be at the macro level, like growth, trade, inflation, interest rates, government policies, fiscal deficit, and the like. It can be at a sector level or an industry level where you do an analysis of the textile industry or the IT industry, etc. Or you may also do a company analysis which is at the micro level. When you move from the macro fundamentals down to industry and at company level, it's called a top-down approach. And when you move from individual companies and then up to the sector industry levels to the macro level, then it's called the bottom-up approach. Because while fundamentals take effect in both the directions, if you look at some of the events that we had seen in the past. So, for example, about a year and a half back, there was this issue of ILFS defaulting on all these payments, and they were in deep trouble, and ILFS finally was closed down, and government had appointed a team of people to look at ILFS and to try to salvage whatever could be salvaged. So that time, that was the time when none of the non-banking finance companies had any problem with liquidity. They were able to mobilize money and utilize that money to lend to lend to those who require money and all that. They were doing that on a regular basis. But once the ILFS default came to the fore, it became very difficult for other NBFCs, even including some of them who have been more or less managing their things properly. They have they had issues and problems. If you look at some of the bigger ones would be banks, financial institutions, then say like an HDFC or a Chola. HDFC or a Chola, then there was not much of an issue as such because they were very big. And as far as the Are you able to see the screen now?
Yes, sir. The screen is visible. Fundamentals and technicals.
Okay. So, I'm not able to see the screen. I'll just stop share and then I'll come back again. I'm sorry.
Okay, no problem, sir.
Are you able to see now?
Yes, sir.
Yeah. Now, when it comes to fundamentals, I told you we move from the macro level, GDP growth, inflation, interest rates, etc., and then we move on to the lower level, the micro level. When you move from macro variables to the lower level, to the company level, it's called top-down approach. When you move from the company level up to the macro level, then it becomes what's called the bottom-up approach. And I told you about individual business like the ILFS facing issues and problems, which we had seen about a year back, and then it spread on to the entire industry. The NBFC sector itself got affected. So there are times when you may need to move from company level to the sector level and to the broader economic level also in analytics and while setting up portfolios. So investing always means that you're investing against a macro environment. And it is that macro environment which is very, very important as far as the investments are concerned, because say for example during the pandemic and after the lockdown started, we had all seen a major crash in the markets. That's because market was not able to make up its mind as to when exactly production and output would start coming out, when exactly shops, establishments, restaurants and businesses would be open for business. Because if corporates are open, they do business, then only it leads to earnings and profitability and all that. So there was a lot of confusion regarding the state of the economy, and now only now it is gradually unfolding itself, and we have seen the GDP growth was minus 23.9% for the last quarter, which means there has been virtually contraction in economic growth. So we need to look at these fundamental factors. They influence the markets. Coming to the technicals, in the technical analysis, what we do is that in technical analysis, we look at price patterns, price updates, because people who are in the markets, they continuously look at price updates and look at the price movements. That gives them an idea about the price direction as also the volumes that are transacted on the markets. That gives an idea about the direction, the quantum of the movements, and what is the pattern that's forming. These are some of the things that need to be looked at while setting up the portfolio and also while buying for the portfolio. Technical analysis is actually based on two factors. One is that technical analysis believes that history repeats itself, which means that as far as history is concerned, the past price patterns and past price actions will be replayed and will be repeated in future also. So there is a price action or a price pattern which was there earlier, and it also means that this price action, the price pattern which we had seen earlier, it could replicate itself in future also. So history repeats itself, and that whatever trends and patterns that you have seen earlier, they will get replicated or they may play out again over a period of time. So you look at history and then try to understand the future. That is the essence of technical analysis, is using charts and price trends and forecast future market movements using trends and patterns. So the two fundamental theses on which technical analysis is built is history repeats itself, and there are clear trends and patterns which could be looked at, which can be seen as you move ahead. When it comes to
Sir, sorry to disturb you. Sir, actually, we have covered fundamental and technical analysis in detail in our subject.
Okay, then we'll move on to
yes, sir.
Maybe asset allocation models you have looked at? No.
No, sir.
Okay.
Yes, we can.
Yeah. See, once when you set up portfolios, you look at asset allocation models, because in all asset allocation models you follow a specific percentage of allocation to assets. So for example, classes debt and equity may have say for example 30% debt component, 70% equity component. So there are different asset allocation models which have been tried and tested over a period of time, which are in use by people who set up portfolios. These are called asset allocation models. There are a lot of asset allocation products available in India also. You could take a look at the asset allocation products available from the mutual fund space itself. That itself is numerous. There, the fundamental thing which they do is that, say for example, a typical asset allocation product which many mutual funds have been popularizing has been 30% into equity, 30% into debt, and the balance 30% into gold, is something that the mutual funds popularized for many years now. So it gives an exposure to three asset classes, 30, 30, 30, 33.33 each, and it gives exposure to all the three asset classes. These are called asset allocation models, and these asset allocation models are, some of them are back tested, some of them have a track record, and then they are put to use. It's also possible for you to set up models based on such models by including more parameters. This is a model portfolio that which I have been using. We have been using at MK Global. We have been using this asset allocation. These are 6 model portfolios which we recommend to suggest to investors. If you look at the conservative investor, the conservative investor will have more of debt funds and less of equity funds. In fact, he has 0 equity funds. He has 30% of debt and 70% of long-term debt, short-term and long-term debt. If you go to the most aggressive investors, it is 80% in equity and 20% in alternate assets. In the case of highly aggressive investors, the asset allocation will be skewed towards the equity component. And in the case of conservative investors, it's more of debt and less of equity. Aggressive investors also take up a lot of alternate assets. alternate assets they are called alternate assets because they are separate and different from the regular traditional assets. That regular traditional asset classes are equity and debt, and those traditional asset classes have have a specific risk profile, which is rather conservative and moderate and maybe moderately aggressive. Whereas alternate assets like real estate investment trusts, units of real estate investment trusts, PMS schemes, gold, these are considered to be much more risky, and therefore the allocation to these products can be found or given only in case of people who have an aggressive risk profile. Moving on to the portfolio attributes, the main attributes usually we look at are risk, return, beta, and standard deviation. When it comes to risk, we have already looked at price risk, interest rate risk, and credit risk we had looked at earlier briefly. These are the major risks that we face as far as portfolio, we need to look at as far as portfolio attributes are concerned. Then we have the returns. Returns we measure as for the performance, because return is something which reflects the performance of the portfolio. And in returns also we calculate absolute returns and also compounded annualized returns. And also what we do is that we calculate what is called rolling returns. And rolling returns is looked at to understand the consistency in performance. Rolling returns is very much like a moving average returns, which will reflect the consistency in the performance of the portfolio, consistency in the returns. Another concept which is quite handy as far as you are concerned is the beta. The beta of the index. Say for example, the beta of the index, say Nifty or Sensex, is 1. The beta of the index is because beta is a measurement of risk. The beta of the index is 1. And if the beta of the share or instrument or security is higher than 1, which means it's higher than the beta of the index, then that share or portfolio or instrument is considered to be of higher risk than the benchmark. So for example, if the benchmark is Nifty 50 and its beta is 1, then any share which has a beta higher than 1 is considered to be more risky, and any instrument which has less than 1 is considered to be less risky. So for example, Nifty is at 1, whereas if you look at SBI, State Bank of India, was trading at around 194 rupees today. Its beta is 1.43, which means that if the index moves by 1, this particular share would have moved by 1.43. So whenever the market is on an upswing, instruments or shares, stocks with a higher beta will move faster than the benchmark. And also when the index is coming down, markets is coming down, instruments which have a higher beta will have a tendency to fall more. So they fall more and they also rise more. So that is how they are, and that's the property of beta. So the beta of the index is 1, and that of the individual shares could be 1.43. For SBI, HDFC Bank is at 1.19. Infosys, I think, is around 0.5. It's quite less. So that's called beta, and beta is also there in almost all the calculations that we make. We also use standard deviation. Standard deviation would tell us the deviation from the mean returns as far as the portfolios are concerned. Because if the deviation is, because when you compare two portfolios, and if one portfolio has a higher standard deviation and the other one has a lower standard deviation, then that will tell you that probably the one with lower standard deviation has lower variability in terms of the returns. But beta and the standard deviation are used in a different context also. That is to measure risk-adjusted return. For all portfolios, we need to calculate the risk-adjusted return when you are recommending portfolios, when you suggest portfolios, and when you evaluate the performance. The trainer ratio and Sharpe ratio are the two risk-adjusted returns that we can work out, and the trainer ratio is used for calculating risk-adjusted returns on equity portfolios. Sharpe ratio is used in debt portfolios. In trainer ratio, the denominator is beta, and the numerator is the difference between risk-free return and the portfolio return. Sharpe ratio measures the risk-free, the risk-adjusted return as far as risk-adjusted returns as far as the what do you call the debt portfolios or debt investments are concerned. We also have what is called the information ratio. Information ratio is nothing but the excess return of the portfolio over the benchmark, and it is divided by the standard deviation of the excess returns with respect to the benchmark return. These are all standard statistical ratios. You could also take a look at it on some of the software that you may be having at the School of Business Management, or you could also Google and get information on all these. But it's very important that you understand what's the risk-adjusted return, and also what is the relevance of trainer and Sharpe ratios, and also information ratio. Still more important, if you're a portfolio manager and you are setting up portfolios and evaluating your performance, net selectivity is something that you need to look at. Net selectivity is also known as Fama ratio, because it's Eugene Fama who set up this ratio. In that ratio, in the net selectivity Fama ratio, Mr. Fama has identified 4 factors as contributory to the returns from equity. The first factor is dividend. Second factor is market premium. The third factor is the stock selection by the fund portfolio manager, and finally the beta. Now, if you eliminate market risk premium, dividend yield, and also beta, then we get the net selectivity, or the stock selection component, which has helped the portfolio to do well. Therefore, it's very important that you take a look at these concepts also when you look at portfolios. In the traditional approach, we move on to the three hypotheses that we had to look at quickly, because I think I have taken too much of time in the introductory part only, but I think it was useful. And we will look at those 3 hypotheses quite quickly, and then we'll close the discussion. In the traditional theory was based on the belief that yes, the markets may be efficient at times, but they are most of the time more or less inefficient, which means that market leaves some room for people to make money. And how can people make money? By the fundamental analyst and the technical analyst can look at the evaluation of the situation and then give their future forecast for prices or price updates, and then help people invest, and then they can make money. This was the essence of the traditional approach to investments. But traditional approach also used to look at, as I told you, the liquidity, which we had seen earlier, the information, relevant risk return parameters, the information that also we have just covered, because many of those things which we covered now is more or less linked to the traditional approach, but at the same time being followed today along with other measures as well. The preferences based on risk profile and the mean variance, the time horizon, what's the time period for the investments. Now, before we look at the efficient market hypothesis, which was the first thing which I was supposed to cover, there are 2 things that people look at, because the discussion is about 2 things. The one set in the efficient market hypothesis, the view is that the price is right. In the group, opposite group, the view is that price is not right. Price is right means what? Because the price reflects all the information available, and any price at this point of time. So, for example, Infosys was at around 1,100 or so today, 1,115 was the level of Infosys today. And HDFC was at around 1,195. These prices, SBI was at 195. Dollar rupee exchange rate was somewhere around 73.25. So these prices which were quoted today, they reflect all the information that is known to the markets, and the markets have already priced in that in the price of these instruments or these products or these portfolios. So whatever is known to the markets is already priced in. And that there won't be much of a change in these prices unless some significant information comes out. Say, for example, we have the RBI monetary policy announcement 2 days from today. The RBI Monetary Policy Committee is going to meet and they will decide about a repo rate cut of 0.25% or 0.5%. Now, where should the 10-year benchmark yield be? 10-year benchmark yield has been at around 6.02% in the last 1 or 2 weeks. Is the RBI going to cut the rate, repo rate? Probably by 25 basis points. There could be some people who would think that they may cut by 0.5% also. But at the end of the day, they may cut or they may not cut at all. It's left to the RBI. So we have very little idea about what is actually going to happen. Generally, what happens is that when majority of the people expect that RBI is going to cut the repo rate by 0.25%, that will be priced in the price of the 10-year Government of India security or in the prices of other instruments like commercial papers, treasury bills, etc. This is the first group of scholars who said the price is right. The price is perfect. It is discovered, factoring in all the factors, and it is an absolute truth. It's correct. The price is right. The other group says that price is not right. The price is not right has a long history of individuals, writers rejecting this thesis. In fact, the most recent rejection came from Richard Taylor, who got the Nobel Prize for Economics, I think 2 years back. He got the Nobel Prize for Economics mainly for his contribution to behavioral finance. He has written a book, Misbehaving, The Making of Behavioral Economics. In this, he quotes Robert Shiller, who was professor at Yale University, because he is dealing in detail with the study by Robert Shiller. Robert Shiller, what he did was that he picked up one stock and tracked the price of that stock for 100 years. I think it's American Water Company. So he tracked the price over the 100 years from 1880 to 1980. It's a very interesting study. I chanced upon this because Taylor has mentioned this in in his famous book Misbehaving, which is a very good treatise on behavioral economics and behavioral finance. So on this particular stock, the dividend that was received from this stock over a period of 100 years was plotted, and based on that dividend, that is that dividend amount that was discounted, and it was plotted, a fair value based on the discounted yield flows was plotted, and Shiller got a curve which extends from 1880 to 1980, which has been broadly in the range of maybe 120 to 150 price US dollars in terms of price. So 120 around 150 was the range in which the price should have been if it was going by the long-term valuation dictated by the discounted dividend. But where exactly the price moved in and out during this time? The price actually dipped to around 60 and it moved up to around 240, 260 levels also. So the actual price in the markets moved in the range of around 50 to 250. Whereas a fair price, which he worked out based on the dividend yield, dividend expected from the scrip, dividend flows, it stayed within a very narrow range of around 120 to 150. Which means that at the end of the day, but at the same time, if you look at the graph, there is a tendency for the prices to converge towards the fair price during the whole time period. So someone who had picked it up at around 150 or 120 was not worse off nor too much well off. So this is one of the studies which was used by Schiller and subsequently used by Richard Taylor to say that the price is not right. The price moved from 50, 60 to around 260. Actually, it should have been somewhere close to 120 or 150. This is a 100 years study. And both Taylor and Schiller say that. Taylor gives the example of the temperature, atmospheric temperature in Singapore. Or you can take it for Delhi, Ghaziabad or Mumbai also. Usually we say that in Singapore, it's in a range of say 32 to 35 degrees. And if the weather is cools down, then it may be 27, 28 or 29 degrees. So if someone gives a forecast of 10 or 40, then immediately you can make out that it's not. Someone can actually give a forecast, but it may not necessarily, it may not be correct. That value may not be very realistic. So people can give any kind of forecast. Markets could also move to some extent to such levels, but may not be sustainable. So if the average temperature is around 30 to 35 or 28, 29, and if someone says 10 or 40, then it's way off the mark. This is the kind of forecast quite often put out even by technical analysts and also market pundits. So the price is not right. This takes us to the efficient market hypothesis. The efficient market, so these are the two lines of thinking. The price is right. The price contains everything. It has discounted everything. It has captured everything. The second aspect of it is that the price is not right, means the price moves away from the fair value. And therefore, you can't say that it has priced in everything. That was why I thought that I'll reproduce this. This is actually a picture I had taken from Taylor's book and then put it there. Now, coming to the efficient market hypothesis. The hypothesis means that the prices which are there today, the index at 11,500 or 11,600, or an Infosys price at 1150 or 1115 on the HDFC Bank, these prices reflect, current prevailing prices reflect all the information. And stocks trade at their fair value at all times on the exchanges. If which means that if Infosys is quoted at 1115, then it has captured all the information on it. Actually had not captured all the information because some news about an acquisition came out a little later, but that was after the market timing. Probably tomorrow's price would reflect that. And that situations of perennial undervaluation, overvaluation, etc. is a myth. There is nothing called, so market trades most of the time, almost all the time at fair value. And it has priced in all the information that's available. And there is no reason for any undervaluation or overvaluation for people to go and buy and make a lot of money. Because if there is undervaluation or overvaluation, it helps the investor to generate alpha and outperformance. Because if you find that something is highly undervalued, then you go and pick it up, it's highly likely that its price could start moving up, in which case you could make a lot of money. Or when a lot of people who found out that it was undervalued go and buy it, then the price would gradually move up. But efficient market hypothesis says that there is no opportunity for every time it's a fair price. There is no room for any undervaluation or overvaluation. You can't make any alpha or excess returns or outperformance. What does this mean? In that case, there is no scope for any stock selection or even for market timing, because say for example, during the pandemic and all that, most of the time what we discussed was that if you're investing into the stock market, invest into quality stocks, because quality stocks of companies with good governance and good cash flows, they will stay afloat and they would still give you good dividends, and its prices could also move up and they may not go down too much. So the stock selection based on the concept of that quality was important during that pandemic and even today, even slightly before that also. The efficient market hypothesis says that there is no role for all this kind of stock selection and all that, and no scope for any market timing, because people believe that a lot of people invested into the markets when the market crashed. In March, the markets crashed, the equity indexes crashed. And a lot of people invested at that point of time, and when it moved up, they sold and they made money. But it is one of kind of a movement, you see. The suggestion by efficient market hypothesis is that the prices always reflect all the information available. There is always trading instruments trade at around the fair value. There is no role for stock selection and all that to pick up undervalued or exit overvalued stuff and then set up a portfolio. There is no scope for generating any excess returns, alpha or outperformance. And this is the essence of the efficient market hypothesis. We move on to one or two components of the efficient market hypothesis in the next 5 minutes. So the efficient market hypothesis, it tells us one thing, that don't get into products or instruments which are offering you good returns, and they will tell you that we are doing this management, that management, this is this model, that model. There's no scope for all these things. And you invest in passive portfolios, low-cost passive portfolios. What are these low-cost passive portfolios? In the context of equity markets, the low-cost passive portfolios are the ETFs, exchange-traded funds. So those exchange-traded funds are, say, compared to maybe 2.5, 3 cost on portfolio management services, 1 to 1.5% cost on equity mutual fund portfolios. The ETFs would be at a very nominal cost of maybe 0.1, 0.15%, and maybe even less than that in many cases. So as per the efficient market hypothesis, just get into a passive investment mode like an ETF, stay there, and you will make all the money that you need. That is what it says. Now, fundamental and technical analysis, does it have any role here? It doesn't have any role at all, because there is nothing to be made from undervaluation or valuation. There is no scope for that. And investing cost effectively is the solution. That cost effectiveness comes from ETFs. ETFs or exchange traded funds have not been very popular in India. But we found that in the last 1 year, the amount of money in exchange traded funds is at around 1.25 lakh crores. 1.25 lakh crores is the amount of money which is there in the exchange traded funds. So people are looking at exchange traded funds, but what people have done is that they still believe in the inefficient markets, that there is money to be made by timing and also by spotting where there is value. Therefore, as of now, it is about 1.25 lakh crores which there in exchange traded funds. I request you to do some reading on exchange traded funds, because it's an emerging area and it will be extremely relevant when you set up portfolios for individual investors as also organizations, because there is a liking for such portfolios to the extent of maybe 15 to 20% in portfolio construction. It is this investment avenue which efficient market hypothesis is suggesting to you. Coming to the efficient market hypothesis, I think the next 5 minutes I'll close the efficient market hypothesis basic propositions. There are two basic propositions. I don't know whether you have heard about James Tobin, was one of the leading American economists, and he got the Nobel Prize for economics, and he was one of the leading economists for a very long time. And he has made his own contributions to this linear programming and also game theory and all that. He has highlighted, he as also other economists have highlighted, 2-3 things which are a mark of the efficient market hypothesis. Those 3 things are, one is called the allocation efficiency, second is informational efficiency. This allocation efficiency, I'll tell you in brief what is meant by allocation efficiency. Because this allocation efficiency or allocative efficiency and also the informational efficiency is presented in the context of a free market economy. It's a free, in the context of a free enterprise system. Say, for example, an economy like the US may not be like that of India, because in India we still have a lot of controls and we do some planning. We have an NITI Aayog, though we don't have a planning commission. We have something else which is regulating everything. And our currency is not freely floating. It is still under managed floating. So we still have a lot of controls. Now the market efficiencies, the two major efficiencies which are talked about is allocative efficiency and information efficiency. Now, as far as allocation goes, the essence of allocative efficiency is this. You take a country like India. What is the total resources for the purpose of this understanding of this allocation efficiency? Say, for example, in India, we have just 100 rupees is the resources that we have. The resources are split into land, labor, capital, and entrepreneurship. But we have 100 rupees of resources in India, and we need to allocate it efficiently. As per the classical economic theory and also subsequent developments in relation to free enterprise economies, allocation efficiency means that suppose you have to produce 2 products. In many of the international journals and all that, they give this allocation efficiency in terms of guns and butter. Butter stands for something which is absolutely essential with bread, and guns, they stand for defending the country, guns and butter. We can put it as potato and rice. So this 100 rupees have to be allocated between 2 goods. In India, we require only 2 goods to be manufactured. One is potatoes, the other is rice. And we have to split this into an allocation between 2 products. That is, and that products, those products are, we have said, potatoes and rice. Now, this is what is called the blue line that you can look at it. The point A is there on what is called the production possibilities frontier. So if we look at the x-axis, okay, if you look at the x-axis, if you are producing rice and if you are using all the money to produce rice, on the OX-axis, the point where the blue production possibilities curve touches the OX-axis is where with 100 rupees we can produce so much of rice. Whereas if you are going to use all the money to produce, say, some other useful article, maybe milk or butter or bread, other than rice, maybe potatoes, then where the blue production facilities frontier touches the y-axis is where we can produce potatoes if you are using all the resources to produce potatoes. So we can either use 100 rupees to produce potatoes or rice, or we have to, but we need both these products. So we need to choose a point which lies on the production possibilities frontier. Any point on the production possibilities frontier, say for example point A or point B, would help us choose a combination of rice and potatoes, different combinations. As far as point B goes, then there will be more of rice and less of potatoes, and less of rice and more of potatoes at point A. So this production possibilities frontier is a limiting factor. It helps us to produce. This is a trade-off between output in different products which an economy can produce. Now, what have we done here? What we have done here is that we have allocated resources, 100 rupees, which is there in India, and that's all that's there in India, between two products which we need, that is rice and potato. If we use the entire 100 rupees for one product, we can produce it at the point where the blue line touches the x-axis, and on the y-axis where the blue line touches, it is entirely potatoes. But we need to settle for something somewhere in between at A or B. If we put it at A or B, then we have enough resources to produce, and we are producing both the goods. In one case, we produce more rice. In the other, we produce more of potatoes. Can we reach point D? We cannot reach point D because that is outside of our reach. Probably we require about 200 rupees to reach point D. Whereas, can we reach point C? We can reach point C. But if we are reaching point C, then we are not optimizing the spends. We would still be left with some money which we could have utilized for production. So one of the points which is lying on the production possibilities curve is the optimum combination of potatoes and rice that we should be producing. Now, as far as the efficient market hypothesis goes, the resources that are available in an economy, the allocative efficiency, which means the best use of the resources available in the economy, the 100 rupees, is decided by the market. How does the market decide about the allocation into more of rice or less of potatoes or vice versa? Market makes this allocation based on the demand for these two products and the price of these two products. The demand for these products and the price of these two products are taken into consideration by the market while allocating the limited amount of 100 rupees to these two products. This kind of allocation of resources at the macro level happens in a free enterprise economy. This is what is called allocative efficiency. In other words, when people needed masks and protective wear, masks and all that, a lot of money flowed into that because there was demand for those protective gear and masks and all that. Earlier, when we didn't have any pandemic situation, what actually happened was that only doctors and some nurses or doctors, surgeons in operation theaters were using the masks and the gloves and the protective wear. Right now, there is demand from the whole population in the country. So there are resources moving into protective gears and masks and all that because there is demand for that. Therefore, resources have been allocated to that. So this free enterprise economy, which is based on the laissez-faire principle, I hope you have read about laissez-faire principle and all that. The essence of laissez-faire principle is that I owe my Sunday bread and Sunday roast not to the benevolence of the butcher, or the baker, but to his self-interest. That's the essence of laissez-faire, which means that people are pursuing their self-interest, and that's why they are producing and selling. So if the prices of goods go up, those goods will be produced more. More funds will be allocated to that. That's the essence of allocative efficiency. But we have now seen millions of people out of employment in India. We have seen millions in the US who are out of employment. Gradually, people are coming back. So allocative efficiency failed there, isn't it so? Don't you think so? If allocative efficiency was good, people would not have been thrown out, or the number of people would have been much less. So there are times when allocative efficiency failed. During the Great Depression in the 1930s, and during the Great Recession in 2006, 7, 8, and also now on account of the pandemic and lockdown, labor has been thrown out of employment, and there is no place where labor could be accommodated. Which is why this allocative efficiency, which is there in the system, when it fails in specific situations like this, government has to come in and spend money. Like Manrega and other things, government spends money and they engage people, give them employment, and also give them means of livelihood so that they can buy essential goods and services. So allocative efficiency is the efficiency of the markets to allocate resources depending upon the market prices and the demand for the products, etc. It need not necessarily look at what are the social priorities. Social priorities could be production of vitamins, production of clothes, which villagers can wear, or setting up of water supply schemes and primary health centers, etc. But the market doesn't take cognizance of those social parameters. It's for individual companies to look at it. This is called allocative efficiency. And allocative efficiency is reflected in the production possibilities frontier or the production possibilities curve. And I have already told you that this allocation efficiency, which is one of the basic things in the efficient market hypothesis, fails. And that is during situations like pandemic, lockdown, and then Great Depression and all that, where governments have to step in and correct it. Sorry. A second and more important thing, as far as efficient market hypothesis is concerned, because these two are the two pillars of efficient market hypothesis. One is the allocational or allocation efficiency, and second is the informational efficiency. In informational efficiency, it's informational efficiency. James Tobin was the front propounder when it came to allocation efficiency, and also he speaks about certain things like operational efficiency and all that. Operational efficiency actually means products and services are given to consumers at a low or reasonable cost, like in an ETF. Then the fundamental valuation efficiency, which means that most of the time prices reflect all dividend, cash flows, dividends, etc. These are some of the things which James Tobin has covered as far as market efficiencies and efficient market hypothesis is concerned. But the two pillars on which this efficient market hypothesis is built is, one is allocative efficiency, and second thing is the informational efficiency. As far as informational efficiency goes, there are 3 levels to it. And these 3 levels of informational efficiency are called, I don't know, you might have seen, you might have studied the concepts of strong ordering and weak ordering. When it comes to demand theory and consumer demand and demand theory, there's something called strong ordering and weak ordering. Here in the case of informational efficiency, there is a weak form efficiency, a semi-strong form efficiency, and also a strong form efficiency. Now what happens is that when it comes to information, the first level of information that we have is information about the past. What has happened in the past? What has been the price of shares or instruments or fixed income bonds or whatever it is? What has been the past prices like? That information is readily available with us. And that information is always getting reflected in the prices today. This is called a weak form efficiency because it is based on only one level of immediate price information, that is the past price action, which is available to all people because you can always go get the past price action on a continuous basis for your decision making. In the second thing, some information may be available publicly, some information may be available privately, and some information may be available only to very select people or to some insiders. Now, in the second case, this past prices plus all publicly available information, when it gets, when these two things come together, then it's a semi-strong efficiency. The price is reflecting past prices and price updates, and it is reflecting also all information available to the public. Because as you know, shares, prices of shares, prices of bonds, they all move with the level of information. And when the information dissemination happens, prices will either move up or prices will start coming down. Prices will adjust for the information. And prices always try to discount whatever information is coming in. So past prices, it's called a weak form of efficiency. That's the first level. At the second level, information is captured, past prices plus also what is available in the public domain. Now there will be a lot of information which will be available in the private domain and insider information. These two things, the private and insider information, are very, very important components because there are SEBI rules and regulations on insider trading, because a couple of weeks before, not a couple of weeks, about a month, a couple of weeks before we have our financial results and all that, I'm not expected to trade in the shares of my company because that could lead to a conflict of interest, and also as far as the insider information thing is concerned. Not that we track our company information and all that on a continuous basis just like that. In the strong form efficiency, are you all with me?
Yes.
Yeah. So I will hurry up now. We have barely 10 to 15 minutes left. So in the strong form efficiency, all the information, both private, public, and inside information, everything gets reflected in the prices. Fama, when he created the efficient market hypothesis, he believed that, and he stated that the prices which is quoted on the marketplace already reflect all the information. And also any small speck of new information also coming in, it gets reflected in the prices. This is the essence of the efficient market hypothesis. The fundamental thesis is that prices reflect all the information. And if it's all the information, the first level of information is past information, the price updates. Then the past information plus publicly available information. And then publicly available information, private as also insider information. So all information is available under efficient market hypothesis. There is no need of any technicals and fundamentals and all that. And people are all aware of all these things. And so if you make money, a lot of money, then you are lucky. That is what it means. So the two fundamental things are allocation efficiency and informational efficiency. And allocation efficiency, I explained to you using the production possibilities frontier, and it's relevant to laissez-faire and free enterprise economies, advanced economies. At the same time, it doesn't support or help allocation because the market sometimes ignores certain socially useful causes and may not allocate, because certain socially useful things cannot be allocated for on the basis of price. It may not be priced on a stock market or in the public place. So governments have to step in and then help and allow social development. this is what in the efficient market hypothesis, this is the chart. This shows that there could be a delayed response to a good news. Suppose a good news comes in. That so what exactly is that good news? That a vaccine has been developed and the testing has been completed of all the 3 levels. It's a good news. Now, in a good news, when a good news come in, there could be an overreaction, which is shown by the red line. When there is an overreaction, it rises, but after some time it just falls off, and then it comes back to the line parallel to the OX axis on the timeline. So there is an overreaction to a new good news, but it gets evened out. Similarly, when there is a delayed response to news also, you can look at this blue curve, how it shapes up and finally meets the line, which is a horizontal line parallel to the OX axis. So there could be overreactions and also delayed responses from time to time to certain news items, because news is flashed into the markets through Reuters, Bloomberg, and similar systems. When these news items are flashed, the market prices move up and down. Now coming to, so this is the efficient market hypothesis we have dealt with. I hope you have understood broadly what it stands for. Now, does it stand good? It doesn't stand good because there are lot of instances of market inefficiency. What are those instances of market inefficiency? One is that there could be insufficient information. Only part of the information is available to the markets. There could be delay in information. Information may reach me faster than you, or it reaches you. Information might probably reach somebody who is in downtown Mumbai faster. We don't know. So sometimes information travels at different speeds, delay in information. There are arbitrage opportunities between markets. It's possible to buy one share at a particular price from NSE and also sell the same share at a slightly higher price or buy at a lower price on the Bombay Stock Exchange and vice versa. These are all arbitrage opportunities available in the market. The market also provides arbitrage opportunities between cash and futures markets. If you look at a particular group of funds called arbitrage funds, you could take a look at that arbitrage funds. If you search for that, you'll get it. Arbitrage funds try to capitalize on the cash futures arbitrage. And there could be special situations and opportunities coming up. There could be a company which is going into some mergers, some acquisitions. Some companies may be going for delisting. All these things can also happen. There could be special situations and opportunities also. Sometimes there will be huge demand for a particular paper. Investors crowd in and then buy a particular paper, so its price could move up substantially, and that could throw the price away from the fair value. Coming to market inefficiency and evidence of market inefficiency, there is a phenomenon called momentum. The phenomenon of momentum is that, say for example, the price of Infosys has been going up in the last 1 month or 2 months. Every day it goes up. Now, if it is going up, it means that it's likely to go up further, maybe another 3 months or 6 months. And if the price of a stock is coming down, last 2 weeks, 3 weeks, or 1 or 2 months, it has been coming down, it's highly likely that it will come down further. This property of share prices is called a momentum. This property is what that a share which has been doing well is highly likely to do well in the coming months as well. Last few months it has been moving up. It's highly likely that it will move up in the coming few months also. Last few months it has been coming down. Therefore, it's highly likely that it will come down further. This property is called momentum. Many traders and speculators and all that, they are people who take advantage of the momentum in the markets. They identify the stocks which have momentum, get in there, make quick money and exit. So this momentum also defies efficient market hypothesis. If you have talked with some brokers and all that, you might have seen that there is something called January effect, March effect, because in January, December and Jan, lot of FIIs sell their stocks because they want to book their profits. Their calendar year has ended, their fresh year is coming up, they book profits. When it goes to March and all that, we'll see a lot of big treasuries, corporates as also banks. They also sell their holdings. We call it the January effect, March effect. These are special periods where the market always follow a pattern. In January or September, there could be a sell-off. So people wait for that, okay, January, it's highly likely that there will be sell-off. So people will be prepared for a sell-off in January or March. So the momentum, the January, March effect, etc. These things defy the market efficiency, the efficient market hypothesis. There are also market crashes. We had seen last March, market crashed. Then asset and credit bubbles. Asset and credit bubbles are caused by cheap liquidity. Then also there are individuals who make statements at the marketplace. I still remember George Soros making statements. One day he gave a statement, this was about 15 years, 20 years back, he gave a statement in which he said that he was going to buy gold. And the price of gold started moving up. So some individuals also create movements in the markets which may not reflect the market's efficiency. So the momentum, things like the January effect or March effect, major market crashes, individual or institutional performance like that of George Soros and Warren Buffett and all that. These things defy the efficient market hypothesis because they have made a lot of money. And a lot of people have lost a lot of money also. So these events and these phenomena defy the efficient market hypothesis. We move on to what is called a random walk theory. I think we might exceed by maybe 10 minutes. Is it okay, Dr. Parul? Is it okay with you?
Yes, sir.
Yeah. I'm sorry that generally when I give presentations or discuss, I have been a teacher myself, and it's so even in client presentations it takes quite a lot of time. It goes on to about 1.5 hours. It should be ideally 45 minutes to 1 hour. So I may exceed time by about 5 to 10 minutes. That's it. In random walk theory, the random walk theory is first in the 1960s, early 90s, 1964 and 65, the first ideas of random walk theory came in. That is from Paul Kuttner and Eugene Farmer, both economists and statisticians of great repute of those times. But finally, the essence of this random walk theory, because the essence of random walk theory is that don't look at these technicals and fundamentals and all that. And you think that if you think that the price is following a pattern and all that, you are living in a fool's paradise. It doesn't follow any pattern. And Burton Malkiel was the person who made this hypothesis very famous, a random walk down Wall Street. He conducted a lot of experiments, and Burton Malkiel is the main person behind the random walk hypothesis. And his writings and articles form the basis of this hypothesis. In a random walk, what Malkiel did was that, I'll just tell you, what Malkiel did was that he did not do any experiment with the stock market or any share or stock. What he did was that he did an experiment with his students. And in the experiment which he did with the students, what he did was that he created an artificial hypothetical stock or share. A hypothetical stock or share was created by him, and he put the price of that hypothetical stock or share as $50. So that was the starting point. Then he had his students, and with them his discussion was that every day we will toss the coin. If it is heads, this stock, the hypothetical stock, its price will go by 0.5 point. If it is tails, then its price will come down by half point. So it was based on just tossing the coin. Hypothetical stock was created, the share was created, its starting price was 50 US dollars, and every day it went up or came down depending upon whether it was head or tail. If it was heads for 3 days, it went up by half point higher every day. If it was tails, that following 2 days, the price came down by half point on each day. So half point higher and half point lower. If the coin toss is a head, half point higher. Coin toss is a tails, then half point lower. And then he charted it for a long period of time. So he got a chart this way and that way. The price indicator was that it was not a smooth curve, as you know, and it was a hypothetical stock. So what he did was that he took it to a technical analyst and fundamental analyst. What he has created the hypothetical, and he took the chart. He didn't tell them anything. And he showed them the chart and told them, what should I do with this stock? Very interesting stock it is. What should I do with this stock? And the technical analyst immediately told him, you should buy this. So had he gone to some other technical analyst, probably he would have said that you should sell it, because there was no pattern as such emerging, because it was a coin toss and a random walk. So this coin toss mechanism is actually a random walk, which means the patterns that you are seeing in technical analysis and all that, the charts and patterns, really these patterns do not exist. Market is in a random walk down the Wall Street, which means that it doesn't take any specific direction. So this experiment of Malkiel, of the starting price 50 and half point higher and lower, while tossing the coin, that you should not forget, because that tells you what exactly this random walk theory is. Now, if you can look at the random stock, the American water sales company, water states company, they are into water and some other utilities. You can see where in the period 2010, 2011, the price movements have been. Anyone who bought the share would have made some money, and he would have lost money also in the subsequent fall. You can see patterns of fall and rise, and also major falls and also rises. So it looks quite random. But if we, which is why it is said that it's a random walk. Market moves at any point of time in a very random fashion, and it's not predictable. This is that of American States Water Company, which is a water supply company, and how its share has moved over a period of time in a very random fashion. If you look at the Nifty, I think this Nifty is of 2007 to 2020. It also shows an extremely random movement. It is not a smooth curve. If you take the period from, say, 2011 to 2014, you can see so many ups and downs in which a normal investor would have been trapped, because the market has been moving in a random fashion. But if you move on to 2014-15 time, you can see the markets taking an upwardly mobile direction. But that's only for a brief period of time. But most part of the time, market moves in a random fashion. Same is the case with an exchange rate, the euro-dollar exchange rate. This has also moved in a very random fashion. And someone who has not been on the right side would have definitely made huge losses in the markets, because there is no pattern as such which is emerging. Except for brief interludes, there is no pattern as such that's emerging. Now, Fama is of the view that as far as random walk theory goes, the Malkiel is of the view that when we say that a particular share has a certain intrinsic value or a fair value, it is all based on expected growth and estimates and rates. We are expecting this type of so much of dividend. We are expecting company to expand its operations. We expect the net profits and net sales to be this much. So there are a lot of expectations. Inflation will be lower. Interest rate could be lower. We could do all these calculations, which are all expectations, and all fundamental analysts will build that in and say that market is at fair value. So he says that these are all based on estimates which pertain to the future, which have 50-50 chance of happening, which is why the market, the random walk theory rejects all these predictions of stock prices as worthless in the long run. In the long run, these predictions which are based on estimates do not matter at all. In technical analysis also, Malkiel is of the view that in technical analysis, you are talking about patterns which happened in the past. You have a price, you got a chart because it's a past price action and you are working on that basis. And quite often, when you give these forecasts and all that, quite late, and you have already missed the bus. And even fundamental analysis, he says that is flawed like technical analysis, because fundamental analysts collect lot of data and information. If you look at equity analysts who do fundamental analysis, collect lot of garbage, lot of information, and quite a bit of that information may be junk and quite a bit may be irrelevant. They work around all this information and then they come out with some conclusions, and sometimes it may not be, which in the views of Malkiel, it would be poorly and incorrectly interpreted at the end of the day. So you can't look at that. So he feels, according to Malkiel, intrinsic value or fair value of stocks you will work out, but that is all based on future estimates of profitability, sales, and all that. One pandemic and one lockdown or such things can, or a major fall in the markets can throw everything into disarray. It is not very relevant at all. All these calculations based on estimates. In the long run, they become useless, and random walk is the right thing to do. Right hypothesis. In technical analysis also, all the projections, everything is given based on past price action, and it means that everything is based on past price action. And what is the guarantee that the future price action will be more or less like that? So it's challenging the assumption that history repeats itself and price action has patterns. So he says that technical analysis, by the time they give out their reports and then all that, by that time the trends may be broken and new trends may be set up by the markets, and you would have missed the bus. So it's practically of not much use. And when it comes to fundamental analysis, they collect all garbage and poor information and give incorrect idea and information about things. So he has said, Malkiel says that fundamentals and technicals are hugely flawed when looked at it from this perspective. But at the same time, random walk theory accepts that in certain cases this theory will not work. That is in the case of small cap stocks. Small cap stocks are small companies who do not have any liquidity on the stock market and who are too small. Sometimes their prices move, sometimes their prices do not move. Generally, people don't go and buy because once you get in, you may not be able to come out. Then random walk theory, there is another exception, which is contrarian strategies. Say, for example, the last couple of months, people have been saying banking has been going down. But now some people are buying banking and financial services, they are buying on the stock market. So they are contrarians. So banking financial services have been coming down. They haven't gone up much. IT, pharma, they have all gone up. But the contrarian strategies, people who follow contrarian strategies will go and buy where they find no value also, or that things are not looking like good value. So banking and financial services sector is a contrarian idea today, and many people are getting in, though generally people say it is going to have bad time again. Then there are a lot of seasonalities. I had told you about the January effect, May effect and all that. There are some stocks which have low PEs, and those low PEs would be could be a buy based upon the prospects, but low PE doesn't mean the stock is very cheap, because the profitability levels may not be good. There are stocks which give good dividend yield, companies which pay very high dividends. They are also considered to be very good. They are, at any point of time, they are a good buy, high dividend stocks, because they will give you tax-free dividends and tax-free income, and that's a very good thing to have in your portfolio, the dividend yield stocks. So small cap stocks, contrarian ideas like investing into sectors which are not doing well now but might do well in the future, seasonalities, stocks with low PEs, and also stocks which have good dividend yield, may defy maybe exceptions to the random walk theory. These stocks could follow entirely different patterns during the course of the price action. They need not be in a random walk theory, because, say for example, dividend yield stocks give a continuous and steady dividend. So people who buy it will stay invested. People who are speculators will not get into dividend yield stock, because there is no price uptick in that, like what they are wanting, the speculators are wanting. So dividend yield stocks are a good exception to the random walk theory. These are exceptions to the random walk theory. Now, so the random walk theory has certain conclusions for us. It says that advisors, analysts, technical analysts, chartists, and fund advisors do not add much of a value, and it's not possible to predict the stock prices. Therefore, if you are doing inefficient markets hypothesis, we had seen that we should buy and hold. We should buy and hold ETFs, low cost strategies. In random walk theory, the strategy recommended is buy and hold. You buy good stocks, hold it, and then you will get the returns in terms of price updates as also dividends. So it's a buy and hold strategy which is suggested. That's it on the random walk theory. The third part of it is the arbitrage pricing theory. I'll take another 5 minutes more, that's it. There are two types of risks that we face in the markets, in the economy. One is called the systematic risks. The other is called the unsystematic risks. Systematic risks are risks that affect the economy, the industry as a whole. These are called systematic risks. Say, for example, government policies, change in government policies, or frequent changes in government policies is a systematic risk. It will affect the whole economy and the industry. When it comes to individual businesses and individual companies, there is a risk. That risk is called unsystematic risk. Say, for example, a workers' strike in a plant or factory is a good example of unsystematic risk. It is possible, it is not possible to foresee systematic risks often. It is very difficult to foresee systematic risk. But it is relatively easier to foresee a strike at a plant and also take action which could nullify the negative impact of the action. So risk which can be foreseen can be mitigated through diversification. So systematic risk and unsystematic risk. And in the arbitrage pricing theory, what does that theory do? The arbitrage pricing theory, very much like the capital asset pricing model. There also our engagement is with an expected return, cost of capital and expected return. That's the essence of the capital asset pricing model, the cost of capital, cost of equity, and expected return. Here also we establish a relationship between an asset's expected return and the macro variables that capture systemic risk, which means that how expected returns are related to systematic risk. Systematic risk, that is what is looked at in the arbitrage pricing theory. Because it was economist Stephen Ross who developed this, and he developed this as an alternative to capital asset pricing model. I hope you have done the capital asset pricing model in your earlier lectures, where we had, can I take another 2-3 minutes? I'll close it in the next 2-3 minutes.
Sure.
Yeah. The capital asset pricing model is based on more or less efficient markets. And capital asset pricing model has one peculiarity, that it is based on a single single variable. It is based on a single variable. It is a single factor model. It looks at the cost of equity and the expected return and the relationship between risk and the expected return, which is captured by the risk-free return and the beta, and also the expected return and the risk-free return. So we have the cost of equity, the risk-free return, the beta, which measures the risk. Beta stands, B stands for beta, it measures, and the market risk premium, which is given by the difference between the expected return and the risk-free rate. Risk-free rate, I hope you know that it is any rate which you can take from the market, which you can attain or achieve without incurring any major risk. Say, for example, the 3 months treasury bill rate issued by the Reserve Bank of India on behalf of the Government of India can be taken as a risk-free rate, 3 months treasury bill yield, or 1 year treasury bill yield, or the repo rate. These can be taken as a risk-free rate. In terms of arbitrage pricing theory, it expands the single factor model. The single factor model, which is which connects the risk-free rate and the expected return and the market risk premium and the beta. Here is a multi-factor model, because there are more than one factor which is influencing the expected return and the risk of the assets and the expected return. In the case of arbitrage pricing, the return is calculated by taking into account various factors like sensitivities that might affect the stock price. The model works in a multi-period cases. The model may not be in a single period cases, because if you're wanting to compare the capital asset pricing and its relevance to multiple periods, you can very well use the arbitrage pricing theory. Also, it emphasizes on the covariance between asset returns and exogenous factors, because whatever is happening in the to the expected returns and the risk that is emanating from there is because of a variety of systematic factors or macro variables which affect the expected returns. All these things are taken care of by the arbitrage pricing theory formula, where the expected return is there again and the risk-free return is given. B1, B2 up to Bn gives the risk associated with each factor and or the risk premium, and B shows the sensitivity. As the formula shows, the expected return on the asset or stock is a form of linear regression, giving consideration to many factors that can affect the price of asset and the degree to which it can affect the assets, sensitivity to those factors. So the arbitrage pricing theory is actually an expansion of the capital asset pricing model, where it was a single factor model. It is made into a multi-factor model, which is why I thought I have shown you the equation in the capital asset pricing model as well as the arbitrage pricing theory. And arbitrage pricing theory maybe can be used to because like capital asset pricing model, which is used extensively when you do a lot of valuation related exercises in the equity markets, which are relevant to acquisitions and purchases and long-term investments and all that. This model can be used to evaluate whether the stocks are overpriced, whether they are underpriced, what is the fair value. And this model is definitely superior to the capital asset pricing model because this is a multi-factor model. That's it from me. Thank you very much for this time to interact with you. And I would suggest to you that some students may have some questions which they can put to me. My email ID is there with with the head of training, Vinita. I think Vinita Arora. She heads the training. She has my email ID with me, with her, and you could reach me. Just drop a mail to me on anything that you would like to know more about, whatever we have discussed today, and also specific questions that you have. Thank you very much. It's a bit late in the evening, and I'm really sorry that I kept you
No, no, sure, sir.